Hey, what's going on, you guys? I'd like to welcome you back to my channel. And in this video, I'm going to talk about institutional trading and also how it relates to what is called the Wyckoff Method. Now, the Wyckoff Method is not an easy strategy or an easy topic to actually grasp, but I'm going to try to break this down as simply as I can, okay? So basically, when you think about the market, the market movers and things like that, when it relates to institutional trading, you're thinking about banks, you're thinking about financial institutions. Us as traders, we're the retail traders. We don't move the market. We don't have enough capital to move an entire market. But this thing happens, with banks and financial institutions, hedge funds, things like that. So when you think about the concept of Wyckoff, there's four parts to Wyckoff that I want you guys to understand. The first part is the law of supply and demand. So when you think about supply and demand, supply, you can kind of think of that as a level of resistance, but supply is, for example, let's just say you're trying to sell something. You have supplies that you're trying to get off. You're trying to sell something. So when supply exceeds demand, that's when price kind of falls off. When demand exceeds supply, that's when you need buyers. So for example, let's think about COVID. When COVID first started, there were tissue and toilet paper. It was in high demand. So a lot of people was trying to buy that. So demand can be a level of support because it's on the bottom, but that's the demand. And that's when price shoots up because you're trying to buy. Okay. Now, the second part of the Wyckoff theory is what is called cause and effect. And so basically within Wyckoff, there's these two moving parts. And basically what it is accumulation and distribution. So what I'll do, I'll go to the charts and I'll show you guys exactly what I mean. So when you're looking at this chart here, you notice that, one of the things I want to tell you guys is when you're looking at Wyckoff happens mostly when price is consolidating, when price is moving sideways. Okay. So with that being said, when we're looking at the charts, as you can see this point here. So let's just say, I'll mark this as a box and you can see this here, price is moving sideways, but this is considered as a distribution. Now, why is that? Distribution happens with Wyckoff when price drops. So you have a consolidation, price drops off. Now, if we look at something like this here, this is considered as an accumulation. This area here, this is considered as accumulation because with accumulation, price builds at the bottom before it shoots off to the top. So in this particular instance, this is when price is actually oversold. And that's when price actually shoots up. Okay. So this is considered as an accumulation here. Okay. So to recap, accumulations happens on the bottom for price to build and shoot up. Distribution happens on the top for price to build and shoot down. Now, the third point that I wanted to talk about is effort and result. Now, what do I mean by that? If you notice within these areas, let's look at this distribution here. You can tell because price is going sideways, price is flat. However, you see this spike here, and as you can see, if you use the volume, if you use a volume indicator, you will notice from effort and result that price is spiking as far as sales. Price is going to the side, it's like I said, it's ranging or consolidating going to the side, but you got this massive sell push here. And so basically what this does, which puts me to my fourth point, it's where the composite man, which is considered as the bank, the man, the evil person, the manipulator, basically what they do, traders will get in here and when they see price shoot up like this, they'll think that, hey, this thing is about to go on a buy. I'm going to go ahead and get up in here. They take a buy position here, thinking that price is going to go up. Price comes up, smack back down. Or another way retail traders might get stopped out is they'll come here and say, you know what, I'm gonna put my stop loss right here. I'm gonna put my stop loss in this area here right above this. And then what happens? They're thinking that they're gonna go for a sell, which they're right in their bias. However, the composite man will come up, stop hunt you out, and then price will shoot off and go in an intended direction. So basically, that's the fourth part, which is the composite man versus the trader. Okay, and so these spikes here are known as springs. So in a distribution, you get the spring on top. In an accumulation, you get the spring on the bottom. So let's kind of look at this, the Wyckoff method. It was created by a guy named Richard Wyckoff, but I'm not going to get all into super detail with all of that type of thing. So basically what I want you guys to see is two things or three things from this particular document is the Wyckoff price cycle. So what we talked about is accumulation happens on the bottom when price is oversold. And then from there, you get what is called a markup, which goes into a distribution phase, which is overbought. And from distribution, that's where you get the markdown when prices actually sell. So in this particular moment, that's when supply is greater than demand. In the markup, that's when demand is greater than supply. Okay. Now, within Wyckoff, we talked about accumulation and distribution. There are these schematics that you can utilize to identify the different phases of Wyckoff when it happens in those specific areas. Now, one thing I do want to say is one of the things that actually tripped me up when I first learned how to trade Wyckoff is I was looking for these intimate moves to look exactly like the schematic. And so each schematic is going to be different and it won't exactly look the same, but you will have these main components within Wyckoff or an accumulation schematic or distribution. That way you can identify it. So for example, when price comes down and it starts consolidating, you'll notice like SCs and ARs and things like that. We'll get into that on another video, but SC stands for your selling climax. AR stands for the automatic rally. And then from there, that's where it kind of produces what is called the resistance and support lines. And you can start to tell which phases happen within those two parameters. Okay. And like we talked about, the composite man, here's that spring down here. So basically what it'll do, it'll stop hunt out, pull liquidity, and then it'll go in an intended direction in which it wants to go. If we look at a distribution schematic, as you can see here, this is when price is coming up to this area. It starts consolidating at the top. From here you have a BC, which is a buying climax, and then an automatic rally. So this is pretty much opposite of the accumulation. But here, this UTAD up here is considered as the spring within a distribution schematic. This is where the composite man will take out your stop loss and all of that kind of thing before it kind of goes and drops off in the intended direction. So let's go ahead and recap. So like I said, this is a form of institutional trading. And this particular strategy, if you learn how to trade it, it can be extremely powerful. And it can help you become extremely profitable. It'll allow you to see the market from a totally different lens. And we're going to actually talk about that and discuss that in detail in the next video. Hey, you guys, I hope this was informative for you, and I'd like to thank you for watching.